part 2 of our discussion on income, we're now at line 10, taxable refunds, credits or offsets of state and local income taxes. We're making our way down through the income section of the 1040. Your tax refund from your state government may be taxable. If you claimed the standard deduction on your federal tax return last year, then your state refund is not taxable. You can skip over line 10. Again, if you claimed the standard deduction on your tax return on your federal return last year, you can skip over line 10. However, if you itemized your deductions on your federal tax return last year and you claimed a deduction for state and local taxes, most often these state and local taxes are withheld on your W-2, then you need to calculate or figure the taxable portion of your state refund. There are some shortcuts in order to help you figure this out. If you filed a Form 1040A or a 1040EZ for the previous year, then you took the standard deduction. You can skip over the part about taxable refunds. State refunds are also not taxable if you deducted the state and local sales tax on your Schedule A or itemized deductions instead of the state income tax on last year's federal return. There are some documents that you're going to need to make this calculation. Form 1099-G from the state or the states that sent you a refund. Your previous Form 1040 and your Schedule A, which lists your itemized deductions. And you need these to calculate what's called the state refund worksheet. And your previous state tax return. Now this shows the refund amount, just in case you didn't receive a Form 1099-G. Here's a typical 1099-G. Box 2 shows the refund amount, and Box 3 indicates the year of the refund. So in general, state and local income tax refunds are taxable if the refunded tax was deducted in a prior year and you received a tax benefit from the deduction. Now let's move on to line 11 on the 1040 alimony. You'll include in your income on the 1040 any alimony payments that you receive. You do not include any amounts for child support. Payments are alimony if all of the following are true. The payments are required by a divorce or separation instrument. The payer and the recipient spouse don't file a joint return with each other. The payment is in cash, including checks and money orders. And the payment, again, is not treated as child support. Property settlements, which are simply a division of property, are not treated as alimony. Property transferred to a spouse or former spouse incident to a divorce is treated as a transfer by gift, which is specifically excluded from gross income. And again, alimony is listed on line 11 of the 1040. Now we'll talk about business income or loss, which is reported on Schedule C. You have to file an income tax return if your net earnings from self-employment were $400 or more. You must also pay self-employment tax if you had net earnings of $400 or more as a self-employed person. If you're in business, farm or non-farm, for yourself, then you're considered self-employed. Business income, Schedule C income, is reported on Form 1040, line 12. And in addition to a small company's bookkeeping records, income information can also come from a Form 1099 miscellaneous, or what's called non-employee compensation. Or it may come from a Form W-2 if you're considered a statutory employee. Most often Box 13 on the W-2 will be checked if you are a statutory employee. So just what is a statutory employee? Well, a statutory employee is a person in business for him or herself, but who's treated as an employee for income tax purposes. Some examples of statutory employees are agent drivers or commission drivers, for example, food and beverage delivery drivers, full-time life insurance salespeople, home workers providing services, and traveling or city salespeople who solicit orders. Statutory employees usually work on a commission basis, and they're considered as regular employees for income tax purposes. So going a step further, what are some of the advantages of being a statutory employee on the tax return? Well, a statutory employee is permitted to deduct work-related expenses directly on the Schedule C instead of Schedule A itemized deductions, and again we'll cover Schedule A itemized deductions in a later module. Statutory employees are usually salespeople or other employees who work on commission, and statutory employees are considered to be independent contractors under the IRS common law rules. Statutory employees are granted a greater tax deduction for their business expenses than other employees because Schedule C expenses aren't subject to the 2% adjusted gross income threshold like expenses on Schedule A. Now, Schedule C is the form that's used by sole proprietors and independent contractors to report their profit or loss from a business. If a sole proprietor keeps good records for the year regarding income and expenses, then filling out this form isn't difficult. First step, step 1, we fill in the personal information, basic information here, such as name and social security number, a description of the product or service offered. The IRS is only looking for a few words here. The business name, if it's different from the personal name, and a business address. Also, the 6-digit code that corresponds most closely to the type of business. If the business doesn't match any of those given in the publications, then we would simply enter 6 nines for unable to classify. Activity codes are found in the Schedule C instructions. These 6-digit codes are listed in the Schedule C instructions found on irs.gov. To finish the top of the Schedule C, we would enter the accounting method. Unless you're quite certain that it's accrual, the answer is always cash, and whether or not you materially participated in the business. For most small business owners, the answer is yes. Step number 2, we fill in Part 1, the income section of the Schedule C. We enter the total sales on line 1. If the business had any returns, we enter that figure on line 2. And if the business sells a physical product or keeps an inventory, then we have to calculate a cost of goods sold on line 4. Now, page 2 of the Schedule C has a worksheet in order to calculate the cost of goods sold. We enter the total sales minus returns and the cost of goods sold on line 7. This amount on line 7 is known as the gross income reported on the Schedule C. Step 3. Now we get to do the fun part. We get to subtract from that income. We fill out the expenses in Part 2. We list each of the expense categories on the appropriate line, and if there are any deductible expenses that don't really seem to match any of the given categories on the form, we total those up and enter the total on line 27A. We add up the expenses and enter the expense total on line 28. Step 4, we calculate the profit or the loss. We subtract line 28, the total expenses, from line 7, which was the gross income, and enter the balance on line 29. If we're deducting expenses for the business use of a home or the home office deduction, we list that total on line 30. We subtract line 30, the expenses, from line 29, the tentative profit, to arrive at the net profit or loss. And that's listed on line 31 of the Schedule C. So, the net profit, if there is any, from the Schedule C flows to two places. Line 12 of the 1040 and line 2 of the Schedule SE to calculate self-employment tax. The net profit to line 12 of the 1040's income section shows up right there from the Schedule C. And the net profit from the business is also entered on Schedule SE line 2 in order to calculate the self-employment tax for the tax return. The self-employment tax is calculated on Schedule SE and then entered on Form 1040, line 57, which is on page 2 of the 1040. The self-employment tax is then added to the regular income taxes that the taxpayer has to pay and becomes part of line 63 on the 1040, which is the total tax. The good news is 50% of the self-employment tax is taken as a subtraction from income, or more correctly, an adjustment, on line 27 of the 1040. This lowers the adjusted gross income on the tax return. So again, we get to take half of our self-employment tax as an adjustment on the tax return. So in summary, if you claimed the standard deduction on your federal tax return last year, then your state tax refund is not going to be taxable. If you filed Form 1040A or 1040EZ for the previous year, then you took the standard deduction. You can skip the part about taxable state refunds. Include in your income on 1040 any alimony payments you received. Do not include any amounts for child support. Schedule C is the form that's used by sole proprietors and independent contractors to report their profit or loss from a business. A statutory employee is a person in business for him or herself, but who is treated as an employee for tax purposes. The net profit, if any, from a sole proprietorship flows from the Schedule C to 1040, as well as Schedule SE for the calculation of self-employment tax. And now, let's tackle some review questions.